and welcome to the next video, where this week we're going to focus on the same chart that we were focusing on last week, and we're looking at risk. Last week we looked at the impact of time on risk and growth and whether we think that might actually be a de-risking factor. This week we're going to look at a more traditional way of reducing risk or reducing volatility within a portfolio. So we're going to use the same chart which we got from JP Morgan that we were using last week. So just to bring it up again, remember what this is showing is historical data all the way from 1950 until the end of 2019. 70 years, a huge data range. Last week we focused on the green bar and the impact of time across the bottom. And we were saying that, look, 1 year, super volatile if you just look at 1 year in isolation. 20 years, however, historically, there's never been a loss if you just held that green bar. Worst possible case was 6% a year return, with the average just over 11%. However, we said at the end, you might not be comfortable with that level of uncertainty and level of potential volatility. So if you were the guy that bought and then day one, boom, big fall, negative 39%, maybe you're that guy, then that is going to have an impact upon your emotional state and you just might not like it. So how do you get around it? Well, the way to get around it is through using the grey bar. Equities and bonds in a 50-50 mix. Traditionally, these asset classes are negatively correlated. What does that mean? As one's going up, the other one's going down at the same time. Doesn't always work out that way, however, that is the traditional correlation. However, when you put them both together and have a 50-50 mix, what you should get is a sort of middle ground which is sort of steadily trickling up, isn't it? And that is the traditional way that multi-asset portfolios and asset managers have reduced volatility within a portfolio. And if we look at the chart, then 5, 10, 20-year rolling periods, the grey bar is the only one where it would have been impossible to run a loss. So over 5 years, the worst possible return you could have got since 1950 with the grey bar is 1% a year. Now, I accept that 1% a year is not a lot, but you get zero on cash at the moment, so it's still better than that. The chances of you being the unluckiest investor since World War II are also quite low. Not impossible, but let's accept the fact that it's quite low, okay? So what you can see is on each year, 1, 5, 10 and 20, the grey bar is the shortest one, which means that volatility has been reduced. So if you are that person that is fearful of volatility and fearful of loss, pick up the phone, send an email, speak to your advisor and get the grey bar. Because ultimately you can see that, historically, since World War II anyway, it would have been impossible to lose with that grey bar. And if you held it for at least 5 years, it would have been impossible to not make at least a small gain. Hopefully you make a decent gain. Look, if that was useful, please like, subscribe to the YouTube channel. It's incredibly important for small businesses. Tell your friends, and hopefully we can start getting some people involved, get some people investing. Don't sit on loads and loads and loads of cash in the bank. It's just guaranteed to lose your money when you inflation proof it. Get in touch with someone like me or local to your area, whatever it is. Ask them about that grey bar, ask them about that balanced portfolio, ask them about the green bar perhaps if you're feeling a bit more adventurous, and find the right vehicle and get involved. Don't just watch your money dwindle in value. It is pointless. Have a great week.